Our next guest has quietly become one of the most successful credit-focused firms on Wall Street, beating its peers like KKR and Blackstone, rallying 20% in the past year, 286% in the past 5 years. Joining us now in an exclusive interview is Ares Management Corporation co-founder, CEO, and president Mike Arougheti. $360 billion in assets under management. Mike, it's good to see you.
It's great to see you. Hi, guys.
So it's the explosion of private credit. You see a big opportunity here. Why?
Absolutely. So if you think about just generally what the economy needs, it's reliable liquidity. Bank failures now, we're seeing capital constraints. Somebody needs to come in and fill that void. But at the end of the day, it's what does the investor want and what does the investor need? And what they need is reliable yield, and it's better if it's floating rate. So what people probably don't appreciate most about private credit, it's a floating rate instrument. So for the last 16 months, it's been meaningfully outperforming while most traditional fixed income instruments are not doing what they're supposed to be doing for the investor.
We hear this from KKR, we hear this from Blackstone, we hear this from TCW. Everyone's in the private credit game now. How do you distinguish yourself? Or is it just there's so much demand?
It's a huge addressable market. I think that there's more equity looking for capital solutions in the credit market than there's dollars available. So there's plenty of room for continued growth. We've been doing it longer than anybody. So having a 30-year track record built up over time through cycles, I think that's the big differentiator. But as this market continues to perform in volatile markets, I think you're going to see more capital flowing, which is not necessarily a bad thing.
And who are you primarily lending to?
You know, private credit is a huge global market. So we lend to the corporate markets. That could be private equity sponsors, family-owned businesses, et cetera, public companies from time to time. In the real estate market, we're a large private lender to institutional owners of equity. In the infrastructure markets, very large private lending business into the global infra market. So I think as the market begins to see more of this narrow view of lending to private equity sponsors will somewhat get turned on its head, and people will realize the value of private credit globally across a whole host of asset classes.
When you think about the silos that are going to need the liquidity, is real estate at the top?
Real estate is probably the tip of the spear right now, and that's a function of the fact that those assets are going into this crisis more leveraged. They've been served predominantly by the banks, which will be pulling back on capital availability. So, yeah, I think in real estate for sure, but right now we're having a liquidity issue more than we're having a credit issue. Private credit is going to be a big part of the solution here, bringing capital into some of these assets when the equity markets are a little challenged to find their footing.
So do you think this is partly why we haven't seen a bigger credit crunch in the economy? Because after these banks started failing, that was the worry. The Fed was worried about it. Investors were worried about it. And we monitor the weekly data from the Fed, and you haven't seen that kind of doomsday scenario.
I think, look, when you think about what's going on in the banking system, it's a little bit of an indictment of the structure, right? Credit is sound. Non-performing loans are low. We're seeing that in our credit books as well. So it's really a function of deposit security and the structure of the liabilities. So one of the reasons why we're not talking about credit yet, we're not really having a credit issue. Job market is continuing to be strong. We're seeing it in our private portfolios that even though debt service is becoming more challenging, cash flow is growing, revenue's growing, and so the setup is actually still pretty good.
So we don't need to worry about delinquencies or defaults? I mean, there's still these arguments that we're headed for a chapter of defaults, right?
Yeah, look, we've been doing this a long time, and each cycle is different. Defaults, by definition, have to go up. We can't absorb this level of increase in rates without seeing defaults increase. That being said, I think the system is deleveraged relative to prior. Both banks, consumers deleverage, corporate balance sheets are healthier. So we're going in with a little bit more capacity to deal with the rate increases. It feels like we're almost at terminal rate. We could argue if we're going to have one more, two more, or none, but we're getting to a point where the market's going to be able to react. And so even as defaults are going up, I think there's going to be enough liquidity in the system to come in and resolve that. So we're not calling for any meaningful stress.
So you think we can avoid a recession?
I'm hopeful. I think that there's a not, insignificant probability that that's what happens here.
Just because you just don't see the kind of leverage and issues that you would typically see going in?
Yeah, I'll give you an example. In our corporate loan book, which is a pretty good proxy for the private credit market, we saw EBITDA growth year over year as of last quarter grow 8%. So obviously those companies are seeing slowing growth. They're having to deal with increased debt service costs. But at the end of the day, when we get to the other side of this rate hiking cycle and the debt service resolves itself, I think people can get on growing at pace.
Are you seeing any imbalances that make you nervous, or that areas that you would avoid? I wonder what you make of this rush into technology and whether this AI productivity story has legs.
I think it does. Again, we're not public market practitioners, so we're trying to think about what are the long-term impacts of this technology on every industry that we touch. Clearly will be transformational. It will also be deflationary, right? And so when we're thinking about what does the next year or two look like as this technology gets deployed, putting aside the valuation implication in the public market, it will have a deflationary effect, which I think will be part of the story of how we get to the other side of this.
You're also in private equity and infrastructure, other sort of private marketplace. Where else are you seeing the biggest opportunities beyond private credit?
Private credit is clearly at the top of the list, and I think the reason for that is the liquid markets are challenged, right? IPO market is challenged. The denominator effect is rolling through the private equity market. So really any part of the private markets where we can come in with a capital solution to create duration or runway for some of these companies to get through this rate hiking cycle is really the name of the game. And so we're seeing that across the board, all geographies, all asset classes, but more on the structured equity and debt side than straight equity.
But do you think there's going to be big competition once the Fed does eventually reach its point where it raises rates enough, and then you could see more money coming back into the public markets?
I would hope so. I think, look, there's a great symbiosis between the public markets and the private markets. So we all want to see the deal machine turn back on. One of the things we do see in the private market is we see a building pipeline of transactions that want to come. So part of what needs to happen is we just need to get stability in rates. The bid-ask spread will resolve itself, and then I think you'll see the transaction machine turn back on. That'll be good for private markets. It'll also be good for public markets.
You sound fairly constructive. I mean, you talk about the most telegraphed recession, if it comes. Balance sheets have had time to prepare and batten down the hatches, and by the time it comes, maybe you do get some relief in rates. I'm trying to think where the potholes are.
I think people are talking about them, but they're trying to talk themselves into it. So we've been constructive since people started talking about the recession a year and a half ago. We have the benefit of seeing 3,000 middle market companies, and what we're seeing on the ground is that the numbers are coming through. So we have to be careful that we don't talk ourselves into it. It's not to say that we shouldn't expect slowing growth, but yeah, we're quite constructive.
And you're not worried about commercial real estate?
I'm not worried about it. I do think there are some structural challenges there that are going to need to get resolved, particularly in the office market in certain geographies. But you can't paint the entire CRE market just with the office brush. And if you really start to dig down and you say, where are the exposures? Office is a big part of this, negative story, but a lot of other sectors in the market are quite sound: industrial, multifamily, student housing, self-storage. So I think there's a lot of tailwinds there too.
We're going to talk a lot about that this hour. We've got Ivan Ho, Cambridge CEO here. Mike, thank you.
Thanks for having me. It's great to see you guys
again. Good to get an update on
Absolutely.
the business. Mike Arougheti from Ares Management.